We're about to talk about exercise E17 23B, but before we do, let's go back and let's review what we talked about in class, or what we will talk about in class in terms of derivatives. In this particular exercise, we're talking about an interest rate swap. An interest rate swap is a swap is an exchange of payment obligations, and the one that we're looking at in this problem, and the most common example of swaps, is an interest rate swap, which is used to convert fixed rate debt to variable rate debt or vice versa. So as I mentioned to you earlier, the accounting for derivatives depends upon whether the derivative is used for speculation or for hedging. Hedging is a use of a derivative to reduce risk, whereas a speculation, the motivation for entering into a speculative derivative is to earn a trading profit. Also, as I mentioned earlier, the accounting for the accounting for all derivatives results in the derivative being reported on the balance sheet at fair market value. What differs across the accounting classes of derivatives is whether or not the gain or loss arising from the change in the value of the derivative flows through net income or is reported as a part of accumulated other comprehensive income. In the case of hedging derivatives, which is what we're looking at in this particular problem, hedging derivatives are classified into either fair value hedges or cash flow hedges. A fair value hedge is a hedge that is entered into to protect the company against the change in price of some asset or liability that's reported on the company's balance sheet. For fair value hedges, the change in the value of the derivative runs through the income statement. In other words, the accounting is somewhat analogous to the accounting for investment trading securities, because the change in the value of an investment trading security flows through the income statement. So the change in the value of a derivative classified as a fair value hedge similarly runs through the income statement. The other class of hedge is a cash flow hedge, and we'll talk about that when we get to that problem. So in exercise 1723B, we've got an interest rate swap that is classified according to the facts of the problem as a fair value hedge. It's a fair value hedge, not a cash flow hedge, because in this case we're trying to protect against economic loss arising from the change in the value of a note payable that's on our balance sheet. In a fair value hedge, the hedged item also has to be booked at fair value, even if usual GAAP would result in that item being reported at cost or modified cost. And this is done to ensure that whatever gain or loss arises from the derivative is offset by a movement in the value of the hedged item in the opposite direction. If you didn't have this symmetry between recognizing gains on the derivative as well as gains on the hedged item, then you would have distortion in earnings. But having this linkage here ensures that that the effect of the hedge on net income washes out. Okay, so let's take a look at exercise 1723B. So here we are. I'm going to kind of read the facts and sort of describe the little diagram that I've here prepared to depict the facts. So on January 1st, 2014, we've got K-Store. K-Store is a borrower. They issue a 10-year $500,000 note at an 8% fixed rate of interest to a lender. So they go to the lender, they borrow money, and the lender says, well, yeah, we'll lend you $500,000. We want 8% interest, and we're going to make the interest rate fixed over the term of the loan. K-Store fears that interest rates are going to fall sometime in the foreseeable future below 8%. And if the interest rates fall below 8%, then they're stuck with this 10-year note which requires them to pay 8% interest when interest rates, if they've fallen, are actually less. So K-Store wanted a variable rate note, that is a note whose interest rate floated depending upon what the market rate was, but the lender wasn't willing to accept a variable rate note. So what K-Store does, again, K-Store is going to be harmed if interest rates fall. They go out and they locate a counterparty, somebody else who will benefit if interest rates increase. So these guys have offsetting risks here, and K-Store enters into an interest rate swap with the counterparty, and this interest rate swap says, okay, counterparty, every 6 months I'm going to pay you a variable rate of interest on the $500,000, on a $500,000 quote notional amount. There is no obligation here, so we call it a notional amount. There's no lending agreement when I say. And the counterparty in turn pays to K-Store a fixed 8% rate on the $500,000 notional amount. So you got interest on a $500,000, 8% flowing into K-Store, which is then remitted to the lender, and K-Store also pays the counterparty a variable rate of interest on this $500,000 notional amount. Now the interest rate here, this variable interest rate, is reset every 6 months based upon LIBOR, the London Interbank borrowing rate. So what we're asked to do is to compute the interest expense on the transaction as of June 30th and at December 31st. So what's going to happen on June 30th? K-Store is going to cut a check to the lender here for interest based upon the $500,000 note, 8% rate of interest for half the year. So let's see, the check will be for $500,000 times an 8% interest rate times 6/12 of the year. Okay, so K-Store is going to cut a check to the lender for $20,000. So let's see, our entry would be credit cash $20,000, debit interest expense $20,000. Then, well, okay, for completeness I'll go ahead and do the journal entry. So interest expense cash. Okay, so that's the entry for the payment to K-Store on June 30th. That's that $20,000. Then K-Store is going to get a check from the counterparty equal to $500,000 times 8% interest times 6/12 of the year. In other words, it's going to be exactly the same as the check that they cut to the bank. Then K-Store is going to cut a check to the counterparty, and the amount of the check is going to be equal to the notional amount of the note, or the notional amount of the swap, times the variable rate of interest that they are contracted to pay, which was 5.6% for the first 6 months. So we got 0.056, and then that's for 1/2 the year. So they're going to cut a check for $14,000. So we've got this $20,000 interest payment made here to the lender being offset by $20,000 check from the counterparty, with bottom line with $14,000 being paid here by K-Store to the counterparty. So the bottom line interest expense for the first 6 months is $14,000. So let's go ahead and finish out our journal entries. This was the journal entry for this payment to the lender. And then we've got, for this receipt of $20,000 from the counterparty, we've got debit cash, credit interest expense, and then for this payment to the counterparty from K-Store, we've got interest expense, cash, so if you post all of these hits to interest expense to the interest expense T account, we've got a debit there to interest expense, we've got a credit here to interest expense, and then we've got another debit to interest expense here. And so if you balanced out that T account at June 30th, you'd get that $14,000 that you see depicted here in the column under 6/30/2014. Okay, the same thing's going to happen on December 31st, 2014. We're going to cut a check to the lender from K-Store to the lender equal to face value of the note times 8% fixed rate times 6/12, another $20,000. The counterparty to the swap is going to cut a check to us, paying a fixed rate of 8% on the $500,000 notional amount times 6/12, and we're going to cut a check to the counterparty equal to the LIBOR rate of 6.2%. That's the rate that's effective from July 1st, 2014 to December 31st, 2014. So we've got the notional amount of $500,000 times the rate now that's been reset to 0.062 times 6/12 of the year. So the amount of interest expense that we're going to recognize, these two cancel out, 15,500. So the amount of interest expense is 15,500. So if we go over here and we do the journal entries again, our first journal entry, the one that we made at 6:30, is going to be exactly the same. So I've got, this is the JE at 6/30/2014. Then here's the JE at 12/31/2014. So that entry is going to be the same. The second entry is going to be the same. And the third entry here, now, rather than being 14,000, is going to be 15,500. So you see, when the dust settles, K-Store has been able to convert its debt from being a fixed rate debt to a variable rate debt, and the bottom line interest expense that they report on their income statement is the interest expense that they would have reported had they been able to borrow from the lender initially at a variable rate interest rate.